July is an action-packed month for Treasury bond investors. As you can see, we started the month with an auction of Treasury bonds on 1st July. We had one on 15th July, and we're going to have one on 29th July for a new set of Treasury bonds, which would mean in 1 month we have had 3 auctions. Now, for this video, the focus is going to be so much on the auction that will take place on 29th July, because what is extremely important is what Bank of Uganda will be auctioning off. Now, they are going to bring back the 25-year bond. The 25-year bond, as we all know it has a 16% coupon rate. It goes until 2050. It was introduced in the prior financial year, and Bank of Uganda sold it off 3 times only in the last financial year. So it's scarce, extremely scarce. It's hard to get it. Also, one thing to note that the 25-year bond, it pays coupon in Feb and August. It actually pays a coupon on August 6th. So the day, it will be 1 week before it pays a coupon. That's something we're going to pay attention to later on when we are doing our analysis. Two, they're going to still sell off the 15-year bond, the 2039 bond. The 2039 bond has a coupon rate of 15.8%. It was last auctioned off on July 1st at the beginning of this month, and it came out at a premium because it was about to pay a coupon rate. Remember, that bond, the 15-year bond, pays a coupon in Jan and July. Then they're going to still sell off the 5-year bond with a coupon rate of 15%. That was also last auctioned off at the beginning of the month. What makes the 5-year bond interesting? It's because it's a medium-term bond that has a 10% withholding tax. Remember, we always talk about tax planning, and we rarely get bonds that are 5 years that have a 10% withholding tax. I know we shall talk about that a little bit later, maybe in December, when we talk about the bond switch, because the last time we had a 5-year bond that had a 10% withholding tax, it's triggering a bond switch at the beginning of next year on 2027. But for this auction, then they will also auction off the 2-year bond. So in this, at the end of the month, Bank of Uganda will be auctioning off the 25-year bond, the 15-year bond, the 5-year bond, and the 2-year bond, which have different characteristics that we should pay attention to on their own. Now, when we talk about the 25-year bond, there is one important thing to pay attention to. We said it has a coupon rate of the 25-year bond has a coupon rate of 16%. The last time it was auctioned off, it came in with a yield to maturity of 16.29%. Now we are yet to see what is going to happen, but we can predict. Now let's pay close attention to what is going to happen in the coming days, right? Let's use 10 million for the auction. Because this bond pays a coupon again on August 6th, it means it's extremely pregnant, like the language we have come to adopt, but that also gives you perspective of where we're going to be. Now, because it also has a higher coupon rate, the chances that this bond is going to be at a premium is 100%. Now, no shortcut to whatsoever, right? It has almost 100, it would have almost 174 days of accrued interest. There is no shortcut for it to come out at a premium. But let's continue paying attention to something that is more important. Now, If we pay attention to the recent auction that took place, that is the auction for the 20-year bond, it came out at a cutoff yield of 15.95%. So if we are to use that as a benchmark, you would expect the 20-year bond to come out at a cutoff yield of 15.95% or more. So if the cutoff yield comes out at 15.95%, it means we shall pay an 8% premium on the auction. However, we have also seen a repetition in the cutoff yield from the previous cutoff yield we had. The last time we had the 25-year bond being auctioned off, it came out at a 16.29%. If it comes out at 16.29%, then we shall pay a 6% premium. No shortcut towards it. However, we have also seen in the recent past where the 20-year bond, the 2043 bond, came out at a 16.5%. So there is a possibility that we might get a 16.5%. If we get a 16.5%, we shall still pay a 5% premium. Now, my prediction is I do not see this bond going above 16.5%. But the only way where we can easily avoid um, a data price where we don't pay a premium is maybe if the cutoff yield reaches close to 17.4%, right? But that is extremely challenging in this day and age. In 2026, it's hard to get a 17.4%. That was last year in 2025. Right now in 2026, the best rate we might get is 16.5%, which will mean we shall get around 5% premium, but it can be as low as 15.95% depending on how the institutional investors price in that risk, and then we shall pay 8% premium. So as you do this analysis and this investment, your goal is to assess to say what is the predictable premium we are going to get. Now, if the premium goes as high as 8%, that means the next time when the bond is paying a premium, a coupon, you will not recover all the money you need to recover on the premium. Like we have said, for 10 million, you would pay a premium of 798,000 but only get a net premium of 720,000. That means you do not recover all the money in August, then you recover it in February 2027. But that's okay because this type of bond is not, it's rare, it has a higher coupon rate. In this cycle, it only competes with the 10-year bond, but this one will always have a higher yield to maturity, so you get a chance to lock in a higher yield to maturity. That is for the 25-year bond. Now, the 15-year bond also, it has a higher chance that it will come out at a premium on that day. If we are to use the 10 million, remember the 15-year bond has a coupon rate of 15.8%. Now, when you understand that is the last time it was auctioned off, actually the last two auctions, it had a cutoff yield of 15.75%. The fact that the cutoff yield has been below the coupon rate, it will automatically mean we are paying a premium. But the question is, at how much will be the premium? Now, if we are to use the 15.75% as the benchmark, it means we shall just pay around 1.1% premium. But right now on the secondary market, the 10-year, the 15-year bond is trading around 15.5%. Now, if it becomes 15.5%, then we shall pay a premium of around 2.5%. However, the the cutoff yield might be as high as 15.95% if we use the benchmark 20-year bond that was recently sold off by Bank of Uganda and the cutoff yield that came out with. Then we are lucky we might end up paying a very, very small premium that is less than 1%. So the only time on that auction we might end up avoiding a cutoff a premium if the yield to maturity is around 16%. That's when the 15-year bond will have a lower yield to maturity. two important things to note. The 15-year bond will have a lower premium than the 25-year bond, even though the prediction is the 25-year bond will have a higher yield to maturity than the 15-year bond. Let me repeat that. The 15-year bond will have a lower premium than the 25-year bond, even though the predictable year cutoff yield of the 25-year bond will be higher than that of the 15-year bond. Why? The 25-year bond, we will be buying it when it has just 1 week to pay a premium, to pay a coupon. Realistically speaking, it means the 25-year bond is about to go through what the 15-year bond went through at the beginning of the month. However, the 15-year bond, for it recently paid a coupon, so it's empty. It has very few accrued interest days, and that is a good thing when you are doing a purchase. So if your goal is to maximize your cutoff yield, the 25-year bond will be the much better bond to go for, though you will pay a higher premium. However, if you don't want to pay premium, there are people who say, I do not want to overthink this. My goal is to make sure I make the right investment. The 15-year bond will be the better option because it will be a lower premium, though expect a difference in the yield, the cutoff yield. The cutoff yield of the 25-year bond will be higher. My prediction is I anticipate that the 25-year bond will breach the 16% cutoff yield. Yes, it will breach it. However, the 15-year bond, I do not see it breaching in the 15.75%. My tentative assessment is that the 15-year bond will have just a 15.75% assessment of the cutoff yield. And that is something that you would want to pay attention to, because for as long as the 25-year bond has a higher yield to maturity, it means maybe long term it will make you more money than the 15-year bond, which will have a lower yield to maturity. And for as long as the cutoff yield difference between the 15-year bond and the 25-year bond is more than 50 basis points, long term, the person who will take on the 25-year bond will make more money. The 5-year bond is still also an option of the bond for people to buy, and the 2-year bond. But for me, my focus is always on these long-term bonds because those are the bonds which I believe make the most business sense. Um, and that for me is this where we have to be in this regard. Thank you.